Hello, guys, and welcome back to the channel. Today, we are diving into a very important theory topic for AFM, which is agency effects in financing decisions. You will find agency theory being discussed in SBL also, to a certain extent in AAA also. It's an important concept across subjects. Now, this concept explains how conflicts between managers, shareholders, and lenders affect corporate finance decisions, especially when gearing or leverage is high. So, the objective here is for you to understand what agency costs are and also how they influence financing choices in real world companies, including Indian examples like Tata Motors and Jet Airways. Okay, now let's start with the basics. First of all, what is agency cost? Agency cost arises because management, the agents, may not always act in the best interest of the owners or lenders who are the principal. Now, first of all, see, a company is owned by the shareholders, right? Shareholders are part owners of the company. Each one of them owns a share or owns a part of the company. All of them are owners. But all those 50 lakh shareholders of a company cannot gather in one room every day to discuss the day-to-day functioning of the company, right? They don't have the time, the expertise, or the ability to make decisions for the company. Plus, so many people coming together and making decisions is never going to work. It will always backfire. So the point is that it might not always be in the best interest of the owners or lenders, that is the principals. And so what will happen is that, see, they will not be in a position to participate every day in decision making. But the company has to function, right? So what they will do is they will have to appoint someone to run the company on their behalf. These people are known as the directors of the company. The directors of the company run the company on behalf of the owners or the shareholders. Now, the shareholders want maximum returns, even if it means taking the highest amount of risk. Now, it is not just shareholders who contribute money to the company, right? The company borrows money by way of loan finance. So there are lenders also. Lenders might not want to bet their money on highly risky activities because they are more concerned about timely repayment of their interest and principal. That is all they are concerned about. So even if a project has a high profit potential but it is risky, they might not be in favor of that. Now, what happens is as the gearing level increases, this conflict becomes sharper because, see, lenders are concerned about their fixed payments coming on time. They don't care about the growth of the company apart from that. The shareholders believe that if the risks are so high, with compulsory debt payments coming in, naturally, they will also they would also expect certain returns from the company, and as the risk goes high, so would be their expectation of return. So the shareholders want to work on high risk projects because that is the only way they think they can get high returns. Lenders prefer safety because they just want their interest and principal back. Now, as gearing increases, the conflict, as I said, becomes sharper. Lenders start to worry that their money is being used for risky ventures. Now, think of Jet Airways before its collapse, right? Lenders were uncomfortable as management kept expanding the routes for, airfare, and they were taking on high cost leases even when cash flow was tight. That's a classic agency situation. Okay. When a company is heavily geared, management acting in the interest of shareholders may take risks from shareholders, may take actions that transfer risk from shareholders to creditors. Because, see, the creditors know about the fact that if the level of gearing increases, if the risk increases, the fixed cash outflows will increase, and they might not receive their promised or committed amounts at the right time. Now, in this case, what the management often does is, see, when a company is highly geared, what the management will try to do is they will try to gamble on high risk projects. Okay, that is most likely to happen. The management might take a desperate bet, invest in high returns but uncertain projects, hoping for a turnaround. If the project succeeds, the shareholders benefit. If it fails, lenders lose because the company might end up defaulting. This is called asset substitution, swapping safe assets for risky ones after a debt is issued. What is a real world example of that? Yes Bank. Before its restructuring, it took aggressive exposure to risky corporate loans without checking for collaterals, without checking for credit worthiness of the borrowers, and that led to immense default risk. To keep shareholders happy, the management may pay high dividends even when the company is struggling, reducing the funds available to repay the lenders. I mean, this happened with Kingfisher. When Kingfisher was under stress, but it still wanted to keep the shareholders happy, it continued paying high management remuneration, signaling poor governance and increasing the debt holder risk. It was a stupid move, but it is something that actually happened. And the company might try to hide problems and cut discretionary spending. They will reduce the spending on research and development, on maintenance, on marketing. While it improves the profitability in the short run, it damages the long-term health of the company. And I mean, before privatization, Air India often delayed maintenance and upgrades to conserve cash, which increased future costs. I mean, I shouldn't be saying this, but the Air India crash, who knows? I mean, maybe maintenance of aircrafts was delayed in order to conserve cash, and that resulted in the tragedy that we ultimately were looking at. Sometimes, in hope that they will be able to deliver bumper returns, you start investing in riskier assets, and that's again you are betting on hope, and that might become your undoing in the long run. Now, why? See, the reason why lenders are worried is if the company does, if these high risk projects or if these activities don't work, shareholders don't have as much to lose as the debt holders have, because debt holders were promised a fixed interest payment and a fixed principal repayment. If the company does not generate enough cash flows because of these risky projects, the debt holders will lose their committed cash flows. So they don't want this to happen. So to protect themselves, the lenders or debt holders, they often include some restrictive conditions, which we call restrictive covenants in the debt agreement. Now, that restrictive covenant could be that if you want to purchase new fixed assets beyond, say, 50 crores, you will have to take approval of the creditors, something like that. Okay. They could put restrictions on payment of dividend, on additional borrowing, on, they could put prohibitions on disposing of major assets without the consent of the lender. They could put restrictions on merger activity unless an approval of creditors is obtained. These restrictions help lenders maintain control over the default risk, but they also create agency costs since they constrain management flexibility. Now, the lenders are not willing to greenlight a particular proposal, but the management of the company knows that if this proposal were allowed to go ahead, it had the potential to bring in extra returns for the company. So, you lose out on making that particular money. And how can we see companies may prefer retained earnings over new debt to avoid lender scrutiny? I mean, the lenders cannot stop you from utilizing your reserve of funds. But when you are issuing a new debt, when you are trying to issue new equity, the lenders could put certain restrictions in the debt agreement, thereby restraining your capacity to borrow more. The borrowing capacity may shrink as a consequence, and which is why, see, agency costs, they influence both capital structure and financial strategy decisions. This interference from the, you know, this interference from the lenders often takes away certain opportunities for immense growth. Okay. Now imagine a company with high gearing. The shareholders own only a small proportion of the capital. Say debt holders have 70%, shareholders have 30%. Now, if the firm undertakes a high risk project and it succeeds, shareholders take most of the gain. But if it fails, the lenders lose heavily, which is why, they are trying to put all of these restrictions on the company until their loan is cleared. And see, shareholders are tempted to gamble because they don't lose much. But the the team might the team of lenders, they might have their own reasons to not allow raising of additional funds or to not allow investment in these risky propositions. Okay. Common shareholder actions that hurt creditors: paying excess dividend to themselves, because that weakens the liquidity of the firm, thereby reducing the funds available for loan repayment. Playing for time: sometimes managers try very hard to hide problems like impending failure by making it look better or window dressing. And changing risk profile: management may borrow for a safe investment and then switch to a riskier project with high potential returns. So this can happen that under the garb of borrowing money for a safe proposal, they raise money and then they use it for a risky project, which is why the which is why the debtors would want a monthly MIS which tells them about the utilization of their funds. Lenders anticipate such behavior, which is why they often put these restrictive clauses under the loan agreement, which could restrict the amount of payment of dividend, or which could impose certain restrictions on borrowing of new funds without the approval of the existing lenders, or certain restrictions for going ahead with mergers and acquisitions. So, and if any of these conditions are violated, then the entire amount becomes repayable, right? And what is the cost of control? The agency cost. These lender protections, while necessary, come with agency cost. Monitoring costs. Lenders spend resources to monitor compliance. See, if the lenders have put a condition that the debt equity ratio should not fall, sorry, the interest coverage ratio should not fall below 5. If it falls below 5, the entire amount becomes repayable. But how will the lenders know what has actually happened? They will have to do a month on month scrutiny of books of accounts to check for this. And for doing that scrutiny, naturally, they will incur a cost, which is the monitoring cost. Then, bonding cost. Companies hire auditors, provide reports, or maintain extra capital to reassure creditors. This is done in order to win the trust and give them that additional reassurance. That is bonding cost. And then residual cost, the loss of flexibility and opportunity due to restrictions on managerial freedom. Basically, your freedom getting curtailed because of the presence of these creditors and the restrictions imposed by them. In that process, you might lose out on certain opportunities for immense growth. And that is where that is again, and that is another opportunity cost which must be factored in while we are discussing the agency cost. Okay, so next time you are analyzing a company's capital structure, remember it's not just about the cost of debt or equity, it's also about agency behavior, because even the best financial strategy can fail if the interests of those in control are not aligned. And make sure that you study this concept carefully. It might come for 2 to 3 marks in your AFM exam. Here are some real life examples that have been given to you, along with a summary table. uh, what is the impact on lenders, what does the management want, and what is the restrictive condition that the lenders can put in the loan agreement. For example, the shareholders want a high dividend, but lenders believe that paying a high dividend increases default risk, so they impose a dividend restriction clause in the loan agreement. Or the shareholders of the company are risk-loving investors. They are risk-seeking investors, so they want to invest the money in high-risk projects in the anticipation of high return. But the creditors believe that this will lead to an increase in credit risk, so they put certain restrictions on where on how you can invest in newer projects by putting a clause that you will need an approval of the creditors before going ahead with such an investment in a new proposal. Or the shareholders or the management specifically might be wanting to conceal poor performance, but the impact is that it will end up misleading the creditors. So the creditors might put a condition that every month they would want an MIS report, which basically summarizes the cash flow and ratio position month on month, the financial position, so that they are in a better position to keep a tab on the proceedings in the company. Thank you so much, guys. I'll see you in the next theory session.